Today's analysis of gold is extremely important because, for the first time in weeks, all major harmonic patterns across the time frames are pointing toward the same risk, the same direction, and the same downside price cluster. On the higher time frames, the H4 chart has completed a textbook butterfly pattern. The B point sits exactly at the ideal Fibonacci zone. And the rejection from point C tells us one thing very clearly. The B leg is over. The market is now unfolding its C leg downwards. This is powerful because the 2-hour chart also completed a Cypher pattern. Price reacted from the Cypher D point and instantly started rotating lower. That reaction confirms that the medium-term upward impulse has already matured, and now the market is preparing for a deeper correction. When both the H4 butterfly and the 2-hour Cypher agree on the same downside direction, the probability of a larger C-wave decline increases significantly. This is not random, this is structure. Now look at the lower time frames. The 5-minute chart is forming a perfect crab pattern. The projected D zone of this crab lies almost on top of the higher time frame butterfly completion zone. This creates a strong multi-time frame convergence. Even the 1-minute shark pattern is only giving a temporary bounce, not a trend reversal. Short-term relief, but still aligned with the bigger downward flow. This alignment is rare. All patterns are pointing toward the same exhaustion cluster below, which becomes the most powerful demand zone in the entire structure. But why is this happening now? The answer comes from macro fundamentals. Gold has recently completed a massive multi-month rally. Central banks added heavy reserves, global tensions supported safe haven flows, and expectations of rate cuts boosted gold through lower real yields. But in the past few weeks, the macro tone has changed. The Federal Reserve has become cautious. Rate cut expectations have cooled down. The dollar index has shown strength, and traders are beginning to delever their long gold positions. This creates the perfect environment for a technical correction. Not a long-term bearish trend, but a healthy and necessary unwind of the previous overextension. Microstructure agrees. Every bounce is weaker, every rally is shorter, and sellers are now defending every lower high. Exactly the type of behavior we see in a developing C-leg. So what does this mean for traders? It means we are inside a controlled decline, a structured leg, not chaos, not panic, but a very organized move toward the harmonic D levels. Those D levels represent the deepest part of the correction, and they also represent the most meaningful opportunity zone for long-term positioning. Smart money waits for these areas. Harmonics help identify them before they arrive. Until price reaches that cluster, the higher probability scenario is continued downside. Every pattern, every time frame, and every macro signal is consistent with this view. Once the D zone is reached, watch for accumulation, divergence, and structural change. That will be the moment when the next major rally can begin. This is why understanding harmonics together with macro fundamentals gives a complete picture. Technicals tell you where, fundamentals tell you why. Today both are saying the same thing. A deeper corrective C leg is underway.